Super. Let me just put this in presentation mode. Well, good afternoon, and thank you for joining. I am going to talk a little bit about trend trading today. And my favorite indicator, since this is very much focused on technical indicators. And I'm also going to go over the trend positions that I have recommended to clients over the past year that are still working and why. When I entered, why I stayed in it, when to basically stay on the right side of the trend to avoid a lot of the chop. This is not a discussion about chasing or swing trading. I consider that to be a little bit different discipline, and I do that very actively since I run a live trading room, but that's a very small time frame, and I like to work from a trend down to a swing and then down to a chase, so I have a higher conviction on direction. So thank you for joining today. If you're interested in that particular topic, I'm going to dig in. So my name is Samantha LaDuc. I am founder of TradeOutLoud.com, also LaDuc Capital LLC, and I founded a trader education and analysis business at LaDucTrading.com. It is my website, and that is where I not only provide a service of trading analysis as well as trade setups, but I also have a full fishing fleet of captains. I'm not the only one. I actually have 8 contributors that join me actively in supporting clients who either are very active traders or active investors, from retail to institutional. So this is my particular approach to trading is market timing. I'm very much big picture, looking for big turns. And that way I can kind of drill down into more actionable trades and share that with clients. The meat of what I do is actually market timing, sector rotation, volatility, but I'm very much focused on trends, durable trends, to use as a backdrop to identify the shorter duration trades and then set those up. And that's just basically a lot of fun if you're really swimming with the current than against it. So I'm focused on discretionary trading. Again, it's what I do. I support clients who do the same for the most part, as well as an edge product, which is an institutional client, which is more macro. And my particular approach is macro to micro analysis. I share my research, my trade analysis setups, including options, because I am very much an options player in this space, some equities, but mostly options. And this particular focus is on the macro themes that have been in strong support of the inflation theme. And if you've followed me on Twitter, or you're a client listening, or you have any knowledge of me whatsoever from former presentations, I have been very strongly focused on a theme of higher inflation, higher interest rates, higher commodities. And we'll drill down to basically how do I identify which ones to position and stay with over the past year, and in some cases, year and a half. All right, so that's the backdrop. I use macro as a backdrop, and then I use what's called intermarket analysis, which is a comparison and contrast type of methodology where I'm looking at instruments to see if there's divergence or similarities to identify something in the bush, right? Something is different, and it's a pattern recognition type of activity, but it's also very much to spot outliers. So outliers revert, and oftentimes with velocity. So I like to study intermarket analysis and the relationships so that I can better predict what's going to happen, whether it be, again, big picture for the sector or indices. And then I will drill down and pick the best underlying stocks or assets in that particular sector. So intermarket for me is a really important next step. And then last but not least is technical analysis. So indicators, and there are many, some you can make, some you can buy, some that just come standard off a charting platform. I actually use a very important one that comes standard with any trading or charting platform. So this is for you even if you're new at trading, or if you're a die-hard professional and maybe you want to simplify it a little bit, this one indicator is just the cat's meow as far as I'm concerned. But this is very much what helps me kind of deliver that trend analysis and then stay on the right side of the trade, of the trend, and then trade around a core position. So I'm doing that for clients across, like I said, chase, swing, and trend time frame. I'm doing it across all asset classes, and I'm using this indicator very, very much across everything. So we'll get to that. As I mentioned before, I have a little bit of a focus here on layered approach, right? So I'm not just macro, I'm not just technical, I'm just not just intermarket. I love to play a little bit with the sentiment analysis. I'm definitely interested in market flow, which is, big positioning, CTAs or options, but they're all used like indicators. And then I kind of get my read and I make some big calls. Right. And then it's kind of cool. I get invited to kind of share my analysis in national media. And I'm very, very focused on helping clients stay in that, that trend. So I have a lot of confidence if I'm doing that analysis. So it's basically whatever I'm offering up for institutional or media is what I'm also offering my retail. So I'm very much, as I mentioned, making that market timing call and prediction. And so part of this trend positioning is coming up with a theme. So it's been really pretty easy over 13 years of NASDAQ outperformance, and especially since the bottom of 2020 COVID crisis with the Fed intervention and the fiscal stimulus and tons of money to have this liquidity explosion in equities. So now it's much, much more difficult. We have a macro backdrop. We have a tightening regime with the Fed. We have geopolitical risk. We have war. We have 40-year high inflation. This is not for the faint of heart. This is not for the newbie. So instead of complicating it with a lot of macro analysis and timing tools, I like to really kind of drill down to, how to keep it sane and simple. And part of that is identifying, if we have selling under the surface or buying under the surface, all of these things that I can do for market timing. But really, honestly, trends are pretty straightforward. And we'll go over that in a little bit. So one of the themes that I picked up on early, and I have been basically beating this over and over and over again drum of things over paper. This is a concept that I came up with back in July of 2020. So we had the bottoming, right, of the COVID crash after a 35% drawdown, March 23rd. Options expiration was quarterly options expiration also. So all of that protection was monetized, taken off the table, and then we had that Fed basically step in, perfectly timed. So the short covering rally commenced, and we went flying higher. And everyone's like, wait a minute, we just had, a pandemic close down society and economy isn't going to grow. And anyway, they attacked us with lots and lots of money in the system, right, through Treasury and Fed dollars. And it basically set up what I believe was going to be an inflationary spiral higher. Yields would go also higher, oil would go higher, and basically commodities after multi-decade lows would be ready for a resurgence. So it was time for value managers to have their day. Now, it didn't mean that the markets weren't going to be bullish. Equity markets advance, inflation, oil shock, dollar was, the whole thing, rate spike. It was still very, very much my theme that we were going to have all of that play out. And then in time, my other theme, which I kind of finally crafted into August of 2020. So very, very soon after I did that, July 2020, things over paper, things being commodities, cyclicals, real, brick and mortar versus tech. We had just we were 12 years at that point of just really strong tech outperformance. FOMO, there is no alternative. You've heard all the catchphrases. All right, so in August, I have some indicators, but it basically said, yeah, I think bonds are done going up. So I started pushing that, and I started thinking we're going to actually have a problem because yields are going to get hot, inflation is going to get hot over time, and bonds are going to start to sell off. we've actually had a huge bond crash in the past year, but it started in August of 2020. And in March of 2021, which you can kind of see from this title, I did a post for clients, oil as an inflation hedge. So we had already run up, from November with the Democrats and Biden and the blue wave and the Pfizer vaccine, and everything was, gangbusters as far as money in the system, lots of nervous bears, because obviously it's going to come back to roost at some point. But it was very much a theme of mine that energy was going to outperform, and it did. So in March, I wrote, it's still going to outperform. It's not done. Just because it ran up from November, to March of 2021 doesn't mean it's done. In fact, it's just starting. So oil is going to be our inflation hedge, and CPI is going to start to get really, really busy. So I wrote this going, okay, careful. And at some point, we're going to get to a point where higher equities are actually going to trigger selling of bonds. It's going to cause a correction, and it would be really, really great timing if we could really think reflation trades, right? Think inflation spike, and momentum stocks sell off because they're overvalued relative to value, and they cause indices to correct. So we did have this year, January through March, we had a big 20% pullback in NASDAQ, but Apple popped right back up and Tesla popped right back up. I'm still a big bear in equities, but the point in tech. But the point is, we definitely had the bond crash, the oil spike with higher inflation and yields. And I want to kind of show you what some of that looks like, and also some of that kind of market timing, and where this still is very, very popular in my mind as a theme, and therefore my trends are still durable. So I'm going to go through my whole list in a little bit. I got time. I'm going to go, this is the precursor. So in October 2021, now we're fast forwarding a little bit. Okay, this is before the November kind of peak in the NASDAQ started to roll over, and then January, the air pocket of risk. But in October, I was here actually at a Synergy conference, and I said parabolas in the making, which was oil. And I had already warned in that post on March 21 that oil was an inflation hedge, and I saw a double from 65.65, which would be $130. And so my timing for that for clients at the time was by March of 2022. Wouldn't you know, on March 8th, we hit $130.50 in crude oil. So this was my exact chart and slide that I had from that October presentation. And it's important to note, because off on the side, I had literally written in 2008, oil was a parabola of inflation on supply chain constraints that broke with deflation from a financial crisis. So that was the 2008. It just kept going up. Major supply issues, equipment, oil servicing, pipes and tubular this and that. Anyway, there was some also labor shortage. We had a really big deal back here into this 2008 crescendo, and it was actually fixed because of the great financial crisis. In other words, it obviously collapsed in a deflationary spike down. We have a very similar setup today. So not only have we tagged 130 and come back down, right? We're in this 100, 105 area today in crude. I still see this moving higher because that has not corrected itself. In fact, we have even bigger supply chain risks right now, labor shortages, this whole inflationary structural backdrop is not going away. So all the levels are now being raised up. And we have, in my opinion, more to come. So this is where we are today. This actually is a chart of CRB. It is a commodities index, Reuters and Jeffries CRB, and it's on a monthly to kind of show you that this was the great financial crisis that broke the oil spike, okay? This is multi-decade lows. And then we have the COVID crash. This was actually caused by the COVID crash. It caused a deflationary oil spike that then whipped around and moved higher. All right, so my macro backdrop is that the COVID crash, right, that whole V-shaped explosion This was outsized. Who expected negative oil? Nobody. Then this was obviously a reaction, an opposite reaction, this reflexive bounce. And here we are. We're still really, really high. And the rate of change for those who are intermarket, so I'm showing you a little bit of my intermarket interpretation. For those who are into the rate of change, it just shows you how incredibly volatile this is and still is. We have not peaked. So I know there are a lot of bears right now. They can't imagine how we could, live on $100 in oil. Well, we've already done that, right? 2014. They can't imagine how we could live on $260 crude oil, which is where I think we're going. But the point is, this was a little bit of the backdrop, right? From an intermarket standpoint, and this macro backdrop of higher inflation equals an oil spike and a yield spike. And you don't need me to repeat all the stuff that's going on right now with the yield spikes that are, just not stopping. I want to kind of go and talk about from then to now, the trades that were set up to take advantage and then stay in because of that indicator that I like to use. But first, I'd be remiss if I didn't also show you the opposite side. So there are trends that have been very, very bullish. They're in that whole class of, oversold value. Think low PE, price earnings type companies, more physical commodity based companies, or the commodities themselves, right? That then caused bonds, because bonds, inflation is the enemy of bonds for the most part. This is just really not their gig. They're not set up for this. We have negative real yields until today. So now you have from August 2020 into today, a very large pullback in bonds across junk, corporate high yield, doesn't matter, right? Or the popular TLT, which is down 28%. From peak to trough. That's a really big deal in the fixed income world. But why I bring this up is because these are bonds, but the bond proxies of tech have been in a downtrend. So this is, by the way, a little backdrop of, bonds broke on the back of inflation, right? And consumer price index just kept going higher and higher and higher. So this was January 2021. We had robust energy, by the way, that it was number one sector. Tech had been the number one sector for years, but all of a sudden, energy leapfrogs to the top of the list of all the sectors for outperformance and stayed there. It has stayed there. Energy has stayed there. Why? Because oil is an inflation hedge. That's my baseline bet. And because, like I said, the bond breakage on inflation was also going to pull down a lot of these speculative hyper growth plays that look like this. So I love this little expression I read recently. I have been basically a big growth to value, I don't even know what you want to call it, advocate, right? I mean, like I'm out there on Twitter and with clients still going, why do you want to trade long any growth play right now when it's clearly in distribution or in a downtrend, like a protracted downtrend? Case in point, this is ARK, and it happened to be going around Twitter recently. I just grabbed it for the presentation, where you can see the NASDAQ bubble, 1998 through 2003, and this is the fractal of ARK. We all know ARK, overlaid, okay? So it shows you this type of action. This is a very, very similar chart if you bring up K-Web, which is the Chinese internet plays, if you bring up the SPACs, if you bring up IPOs, if you bring up EVs, if you bring up crypto, if you bring up biotech, they all look like this. So I just am at the point where I have, at the first of the year, I did a prediction that NASDAQ would underperform, and it has, no question. But this has actually been in place since February of 2021. So after this long, move higher of FOMO and TINA in stocks, underneath the surface, we have really, really fallen apart in FOMO, TINA, and high PE growth ratio stocks. So this is the expression. It's like man digs 12 feet deep hole without realizing his metal detector was picking up his steel toe cap safety boots. So folks are still hardwired. A lot of retail is hardwired to keep going in and buying when they just keep getting their head handed to them. They don't understand. It's like digging a hole and the metal detector is picking up the steel toe cap. So maybe that's too farm girl an analogy, but I love it. So this to me is dangerous. I don't get why anyone would want to trade in this, what I consider a gorgeous short, protracted downtrend for growth, and a gorgeous long in the protracted uptrend of value. So that's just I guess another preaching of, I don't think we're done, by the way. I don't think it's based and firmly enough in the growth sector to be a safe long. I don't even know what Tesla was reporting after hours. I don't care. The point is, these are much better plays. So commodity price changes over the last year have been, and this is just over the last year. This isn't since my July 2020, things over paper, which obviously indicates my preference for commodities. So the point is, it took a while. So I had the idea of this durable trend, but it really wasn't proven for several months, right? When we had, in August, when I said, yeah, I think bonds are done going down on 2020 of August, it then had to be proven. And then we had, the November Pfizer vaccine announcement, we gapped up and everything went higher. But the point is that I keep testing. And just this year, for example, Nat Gas is up almost 200%. Nickel, what's happened to heating oil? I mean, my costs have doubled for oil and they're 70% higher for electricity. I mean, what's going on. Wheat, yes, Ukraine, but we had it beforehand. Soft commodities, soft goods are still in hot fire flame mode. And they're not going to go down to where they came from. It's going to be a higher base. Lumber is going to be a higher base. Caught that one very early. Anyway, the point is, trends here have been long commodity things over tech, which is paper. And that's basically the whole purpose of showing you, okay, so once you get this, macro concept, and for me, it was things over paper, then my intermarket showed that there was a rotation going from growth to value. It triggered in September of 2021, and then it triggered again in November of 2021. And I was really, really excited about that because it confirmed for me that I had higher conviction that these plays were still in play. And by the way, my intermarket still confirms growth to value, has not bottomed yet. Bonds have not bottomed. Oil has not topped. Growth has not bottomed. Commodities have not topped. So for me, this was my trend long call set. So under inflation, cyclical value, which by the way, for years, I was focused on growth too, because it was hot, right? It was phenomenal. Even early last year, with all the meme stock madness. And I was very happy to be long GameStop from also summer of 2020. The point is, it's done, right? That ended. That speculative, fever ended. So what has not ended is our backdrop of we are short everything from supply chain crises, right, to too much, money chasing too few things. We're short homes, cars, food, commodities, workers. Fed, Treasury, Congress spent tons of money in percentage of GDP and handouts. That's also paper, right? Not things. It's not going to fix the supply crunch. It's not going to fix the Russia-Ukraine war. So scarcity of hard assets over inflated paper was my trade idea then. And I have basically tested every month since with clients. And right now they're kind of running on their own. So unless something breaks and I have to take it off my trend list, they're still going. Okay, so these are some of the areas of outperformance, and these are the ones that I picked. So let's talk about them in particular. And I'm just looking real quick to see if there's anything as I'm talking loudly and quickly if I missed any questions in here. Okay, so, oh, thank you. That oil call is still not done. All right, so you can see that these are my favorites right here. Okay, now if I go down, I'm going to kind of emphasize again that everyone has chase, swing, trend, time frame, and you define it yourself, right? So for me, a chase is something like this morning, $900 puts in Tesla, or shop, it broke a key level, and it happened to go down 10%. But the point is, those are chases because they're technical in nature. And they're really typically only lasting 1 to 3 days. They employ options, for me anyway, 1 to 3 weeks out. And I use an hourly chart. Swings are a little bit different. They are trades that typically last 1 to 3 weeks. Okay, so there's going to be a direction involved, there's going to be a digestion involved, then there's going to be a breakout. So what I'm trying to do is time basically a volatility entering that instrument, whatever it is. And then I'm using options that are 1 to 3 months out. Like, for example, recently I put on a Gilead trade because it was a bottom fishing and it looked like it was going to move in the next 1 to 3 months, but I used a June financed call spread. We're in April. So, and it did exactly what I wanted it to do. It popped up very slowly, went sideways, and then broke out higher again. So trends for me last typically 1 to 3 months. They start out, I'm expecting them to last 1 to 3 months. So far, some of these trends obviously have been a year and 9 months. So since July of 2020, I tiptoed in with a little BTU. I started obsessing over it when it was $2.50. Didn't actually do anything until it was $5. We're going to go over BTU. It's much higher. The point is, these typically, I start out liking them for 1 to 3 months, and I use options 3 to 6 months out. And I'm using a weekly time frame, which is what we're really going to focus on. So I'm going to back up a little bit because there is this trend dismissiveness of trend trading by some people, whether they are highfalutin macro managers that really want to complicate things, or they are newer traders that just don't think they're going to get the thrill because the time frame is too long. And yes, you've got to be very selective where you spend your money, where it gets locked up, and you've got to actively manage it. So, they're not for everybody. But for a lot of folks, whether you're sitting at your computer all day long like I am, or you're just checking in at the end of the day or end of the week, I think this is definitely a mindset that trend trading is somehow, I just need to demystify it. So recently, a few days ago, I saw this, Michael Covell did a book in, 2008, 2007 called Turtle Traders. I've never read it, but I looked at Wikipedia to see what it was about. Sorry if I'm, embarrassing myself by not knowing this. But Richard Dennis believed trading could be taught in a nutshell. Dennis trained this group known as Turtles for only 2 weeks about a simple trend following system, trading a range of commodities, currencies, and bond markets, buying when prices increased above their recent range and selling when they fell below their recent range. They were taught to cut position size during losing periods and to pyramid aggressively up to a third or a total of total exposure, although only 24% of total capital will be exposed at any one time. By the way, I literally just 2 days ago did I pick this up. William Eckert, on the other hand, believed trading couldn't be taught. Having a strong analytical and mathematical background, Eckert believes that the correct application of statistics and mathematical concepts is key for successful trading. However, he highlights the difficulties in using these concepts, mentioning that the analysis of commodity markets is prone to pitfalls and statistical inference, and if one uses these tools without having a good foundational understanding, it's easy to get in trouble. Eckert was wrong. The folks that they handpicked for this experiment, dubbed, turtle trading, ended up to go and gross over $150 million in 4 years using a simple trend trading system. I don't actually know what the trend trading system is that they use, but I love this comparison. I love this highlighting of a cerebral approach to complicated trading and then a very instinctive, simple one. So I'm obviously with Richard Dennis. So this is where I kind of go, and I'm going to show you the positions on a weekly chart. because this indicator is best used on a weekly. And for me, I have gotten very, very comfortable with this indicator or all of my set of tools, right? How I process data, how I interpret my intermarket, how I technically size up risk, low risk entry, right? Stop loss, profit target. It's a personal thing. It's a personal journey. So go easy on yourself. Find something that works and really works and stick with it. This is what I teach because it works for me, and instinctively I'm really, really comfortable with it. But for me, it's the 10-week EMA, exponential moving average. It is my absolute favorite technical analysis indicator. It supports my trend trading time frame so that I can time a low risk entry, manage the position, obviously with confidence, knowing when to hedge or when to cut bait. That's my fishing, metaphor, because I have a website and let's go fishing. So it's not what you look at that matters, it's what you see, Henry David Thoreau. And I just believe that. I believe you need to interpret the market in your own way so that you understand it and you can really work to, just get confident in that understanding, your language, just interpret it in your language. So that doesn't mean that I'm not dismissing news or policies or any of that stuff. That's all fun and that's all fine and dandy. Because I'm definitely looking at macro events. I'm definitely looking at intermarket analysis. I'm studying and mastering pattern recognition. So if you're a technical trader, you are a pattern recognition expert. Like that's what you're looking for, the secret sauce that's going to be a consistent, repeatable process. So I'm identifying points of inflection that bring volatility into a name through my pattern recognition. And then, of course, I love options. So I have to look at option flow. I have to look at market structure. There are tricks of the trades that I learn as I am a curious analyst, educator, and trader. But when it comes to actually just live trading, I'm looking at that 10-week more than anything else. More than anything else. And I use time frame congruence. So I use a weekly, a daily, and an hourly chart side by side, and the indicators side by side, so I can basically kind of like count cards. And that allows me to then position, suggest, set up option trades based on that analysis. So that's basically, in a nutshell, my concept of how I get to here. Now, let me just show you some of the physical. Let me get this up too. All right, so we're going to go to my list. Give me a minute. All right, so this is, first of all, my website for retail and for institutional. Got to throw that up there. These are my trends in play. Now, I have a fabulous live trading room moderator by the name of Tiffany. So she maintains this, and we keep it actually in my, hold on one second, in my slew, if I can get it. There we go. So this is basically how it works. I have a Slack workspace, and then I post my trends in here and what's new and basically my list. It's very, very much focused on letting clients know why I'm going into a trade, where I'm setting it up, and why. So there has been a lot of success trading non-tech. In fact, if I was to, I'm sorting by sector here. Okay, there's nothing here that's tech. I can swing trade, maybe. I really don't even have any swing trades. I will chase tech right now, for the counter trend, but I haven't done any trend trading in tech. It has been solidly in value, staples, energy, defense contractors, healthcare, materials, and transportation is not working out for me right now so well, but I should have had more utilities. Let's put it that way. But we're just going to start kind of going through my list, and I wish I could leave it over here, but I can't. It won't. If I do this, it disappears. So I'm going to keep it off to the side. One second. Maybe I can do that. All right, so this is my 10-week. Let's do this. Let's go right through it. Ignore all the noise. This, by the way, is the hour. This is the day. Okay. And this is the week. And I want to show you, kind of get this out of the way a little bit more. I want to show you why the 10-week EMA is so cool to have on your charting or trading platform. There are lots of other lines here that I manually enter, by the way, and there are Bollinger Bands, but basically I'm using my 10 EMA, and then the one below it, there's a 21 EMA, a 30 EMA. I do have some Keltner channels in here. I do have a 50 and a 100, a 200, but the 10 is really important for staying in the trend. So here's AbbVie. It's a healthcare play. It actually was introduced to me by a client, and then I was totally watching it because I thought, okay, it's important to him. I know it's his major position. I'm going to keep my eyes on the prize, but it also is it's in a sweet spot. I like this sector. So once this broke out of prior high, okay, from the September 2021, kind of did this basing at the 50 and did this sideways, but it got above the 10-week. This is the 10-week, by the way. Once it got above, it never looked back. It was just a gorgeous trend breakout. Didn't know how strong it was going to be at the time, okay? And I did not get it on the lows by any stretch of the imagination. In fact, I waited for it to break out and got it about 129. But the point is, every time it even digested a little bit, it got saved by the 10-week. Then it broke out, shallow pullback, sideways, broke out. Now it's obviously come back in. There's some serious profit taking. That's a bearish engulfing. It hit the Bollinger Band. It's going to probably kind of come down to the 151 area, snake around, and start a descent. So this is no longer safe once it gets and closes below the 10-week, but it hasn't happened yet. But the fact is, this is an example of how the 10-week is a beautiful way to stay in the trade. If you look on a day time frame, there's a lot of choppiness. I mean, some are really choppy, but it's still doing a really nice job with this kind of like 45-degree angle. Then it starts to get a little ahead of itself, gets a little bit more parabolic, and then reverses quickly down to its mean. So believe it or not, this is not broken yet, but I'm obviously very much aware that this got extended. It's in distribution, very much a beautiful trade that needs to be protected now or sold. I think we're going to get into a place where, hey, it's had its run. It's going to migrate to something else. All right, so ABC is another one. I'm literally going to go right through the list as quickly as possible. These are all recommended plays and when. So this is another one that's in medical distribution. It had a beautiful kind of sideways consolidation. It broke out. It's not a big fast mover, but nonetheless, look at the 10-week. Look at the 10-week. Look at the 10-week. All right. So this was entered at 140. So I was late to the game on this one. Came out, retested beautifully, and that's when I liked it. So this is doing really well. It hasn't done anything wrong. If you were looking only at a day chart, you'd probably go, oh, this is messy. This is messy. But to me, I don't look at that. I like to smooth out the noise with trends and use the 10-week. Okay, Archer Daniel Midlands. This was also another one within the same kind of space of farm products with inflation, but it really didn't break out until pretty much near this year. Broke out, pulled back, but did not close below the 10-week, which by the way is very important. Exploded higher. Didn't grab this one until about 74, but the point is it has done a great job, stayed above the 10-week, broke out, shallow pullback, broke out, sideways, and now it's still continuing higher. This is gorgeous. There's nothing wrong with that from a trending perspective. It hasn't done anything wrong yet, right? It is getting extended, and it wouldn't surprise me if a lot of these trend plays come down and test the 10-week like the ABBV did, but there's nothing wrong with that chart. Okay, another one is AEM. This was only entered recently. It was in the gold space, okay? I picked some miners because gold would finally gotten above 174, and I liked it. So this was literally just added recently. I want to have some gold miner exposure. It hasn't really gone too far, too fast yet. It's up 14% on a stock basis, but keep in mind, these are all on a stock basis. I trade options. So, but my clients may not. They may be stock only. They may do options very professionally, like around a core position. They'll sell calls, they'll sell puts to defend against, they'll manage actively. However they do it, this is how I do it. Okay, I'm using that system I just showed you, right? If it's a trend, I'm going to be in it for 1 to 3 months, and I'm going to use options 3 to 6 months out. Okay, so this is a new one, Anthem, gorgeous. I'm just going in alphabetical order. Anthem is healthcare. This is with UNH, both beautiful. It broke out. It retested that 10-week end of trend line, broke out, came back, and it's a little bit choppy around here, but it's still safe because it's above that trend line. Broke out. It's still in trend, just like Anthem. Okay, broke out, came back, but it stayed above the trend line, broke out higher, came back to the 10-week. It's a little bit more choppy. These are a little bit more choppy. So some personalities of stocks are going to be seamless and others are going to make you a little bit crazier, but the closes have been fabulous. The other thing that you can do is use the 21, which is what I do, right? You can see how it has a relationship with the 21. The next is the 30. The next is the 50. I'm very excited about the 50. As long as it stays above the 50-week, this thing's in trend. Just like you use the 200-day on a daily. Okay. APA, we're going to go right into, I'm going alphabetical, but I want to show you just so you can kind of get this feel. APA is, of course, an energy play. It's up 33% on the stock basis since I entered this one, and that was at 33, kind of late. This was a later one. I've got CVX from much, much lower, Exxon from much, much lower, but APA is a new one. It basically, to me, it had to get above, stay above the 200, prove it, break out, retest the 10, break out, retest the breakout. So this is how I use the 10-week, okay? ATI is metal fabrication, and it's basically, you know, think steel, and very, very much under the radar, and not a fabulous, sexy option market, but it did a great job of coming out. Again, this was a little bit early. It came right back, all of the congruence of moving averages, and then spiked higher. So everyone was so excited this week on Twitter because it broke out, right? The 52-week high at 28.50. I've been in ATI since 22. So since this retested and came back up and broke this weekly high, that's when I entered, and it has stayed firmly above the 10-week. So everyone is different. How you size up a trend of when to enter or why. This is my system. I'm showing it to you. This is a little bit different. AXP is not at all a safe trend trade from a 10-week standpoint. It had its moments, right? This is definitely in distribution. Financials are a nice quote unquote value play, but we have all kinds of other headwinds, consumer related and the rest. So this is more of a fundamental thesis than it is a smooth trend trade. BG, and you can clearly see gorgeous farm products have just been hot, hot, hot. This is since 77. So it basically came down, it had a great scoop, it had a great trend, and then a scoop down to the 50, broke out, retested the 10, broke out, retested the 10 and the prior breakout, and then boom, it has been off and running. Beautiful trend, nothing wrong with it, nothing wrong with it. Just gorgeous. Okay, BHP is, you're going to have a few of these industrial metal plays, also some, you know, Brazilian exposure, etc. But the point is, this has been a little bit more choppy. Just entered this recently at 68.55. It had to get through this digestion, but you can also see it got above the 10, broke out, came back, tested the 10, broke out, came back, tested the 10, broke out, came back, tested the 10, broke out. So it's a choppy trend, but it's still working, and it's a gap up. So this thing has some, you know, energy to it. Next is BJ. Love BJ's. This has actually been a long time favorite of mine since about 32 and a half. This was one of my summer suggestions. I like Costco. I don't mean the store, but I mean the business model. And BJ's is like the little cousin of Costco. Someday I think this is going to be a Costco. So this is, again, kind of more of a fundamental play, but it also has done a good job of growing up. It's gotten a little bit more sophisticated, and it has still stayed basically, you know, in line with the 10. But again, this is more of a fundamental long-term view than just a 10-week. Berkshire, I had to have a financial. I liked Berkshire best. It also is very close with SPY. It's very heavily weighted at SPY. But this is another thing. This is the 10, gorgeous. Now, fundamentally speaking, I like Berkshire because it has a tremendous exposure to hard assets. I know it's surprising, but it's not only heavily weighted in SPY, it's not only a financial, insurance, which is also a cyclical, hard asset exposure, Nat Gas. After the Texas debacle there last year, Berkshire got involved in Nat Gas heavily. So this has been a fabulous trend trade as well. It got extended. And when they get extended from their mean or their 10-week, it's very likely going to come back. And as long as it stays above the breakout, it's fine. So you can just kind of get this 10-week up there, and then you can see the behavior of these stocks. This got a little bit extended, and now it's digesting sideways, but the trend is still in play. And then you can sell calls against it, or you can buy some puts if it gets too extended, but it's still in play. BTU, that was a bottom fishing play. And honestly, this is a scary one. I should have picked Arch. Arch would have been a better horse, but I was very, very excited about this base back in 2020. And so started talking about this. It actually broke above the 10-week about 2 and change. I didn't get excited or into it for confirmation until about 5. The point is, it got up to the 200, came back to the 10, made a lower high, unfortunately, and scooped all the way back down to the 50-week. Remember, I said I have a very, very important kind of line in the sand for these trend trades. Even if they pull back, they cannot break the 50-week. And it has just been obviously hot fire flames. So BTU is kind of an exception. It's been around for me since $5.30, but I have clients who got in early. CCJ and uranium. This is another thing. I had a risk manager who is very heavily involved in uranium. This is very busy, sorry. But this was a huge position for him. So obviously it also fits my theme. I talked about it in December of 2020, that this looked extremely oversold and was going to move higher. It had some very strong pullbacks, saved at the 50. So this is much more choppy. This is more of a thematic play than it is a 10-week moving average. It's not behaving well. It's still absolutely in scarcity. So I want to have exposure to CCJ and uranium. Despite the fact that they break my rule of a 10-week, got saved at the 50, but way overshot it to the downside for uranium. But CF, oh goodness, this is an agricultural input and has been hot fire flames with IPI and Mosaic. So 3 of these have been on my trend list. CF since 56 bucks. And this is basically a trend line that broke out. It kept coming back to the 10, kept coming back to the 10, kept coming back to the 10. And then it just, last time, it was the last time. And it has been obviously explosive this year. And before Russia invaded, by the way, Mosaic was long before Russia invaded, by the way, and IPI was also long before Russia invaded. So the point is, these have been in trend because they have just been in that same space of food inflation and agricultural inputs. And then we had spiking yields, spiking oil, and spiking fertilizer. But these were all positioned earlier because of the theme and because of the 10-week, just gorgeous. So CLF and other kind of steel plays, CLF is kind of slow to launch, but I want to show US Steel. So US Steel did this incredibly choppy. I'm like, when is steel going to take off? When is steel going to take off? Well, it finally took off at 20 bucks. This was an overshot, and then it got above all the moving averages, screamed higher. I didn't move this into a trend trade until it was about $23.50. So it had to clear this trend line, stay above the 10, and obviously it's doubled from 20 to 40. It didn't actually position this into a trend until about 23.5. But the point is, this is now monthly resistance. Instead of getting rejected violently, it's digesting sideways in time versus correcting in price. That's very bullish. So I'm still very bullish US Steel. Copper's doing a little bit less of a run up, I will admit. COPX is okay. FCX is doing okay, but they're not winning any awards like a Costco, right? This is a fabulous, gorgeous trend. Look at the 10-week. Look at the 10-week. Now that got a little scary. It overshot right down to the 30, but then it got right back up. So Costco, and you can do that. Get out. If it breaks and closes below the 10-week, get out. One that I suggested recently to get out of was Cisco. Cisco had been a trend trade and it gapped down. I do not like weekly gap downs. They are very, very bearish. So anyway, that continued to sell off. I now have that as actually a swing short once it broke 53.25. There are many others. CVS is still doing okay. There's, DBA, which is of course the agriculture ETF, doesn't move, like Jagger, but it's very respectable. And the stuff underneath it is obviously much stronger. The corn ETF, the wheat ETF, etc. So those are still fine. CVX and Exxon have been my faves and have been in play for quite a while because they're not going to go anywhere. They're just not going to go anywhere. So Exxon and CVX have done extremely well to, move. Look at this is the 10-week, right? Now it's getting a little expanded. Oxy is another one. Oxy's been in play for a long time with the same kind of premise that it's not going to go anywhere. And then it had this, 10% Berkshire is adding and Icon is selling. But the point is, it's been a choppy trade, but the themes have been really, really strong. I have a bunch that are also, I'm not focused just on oil. This is actually Craig, our macro advisor, was very excited about LNG. And once this finally broke above 90, finally got into it about 98. So it's now, 138, but it's still this 10-week, is kind of holding it and it's doing fine. The better horse was EQT. So that actually worked out, but that has been along since about 21. So this broke above, went sideways, and then exploded higher. And this is because of the Nat Gas, parabola that we have all been trading and paying up for, both here and abroad. So that is not the same thing as, for example, a swing trade. UNG was a swing trade that I recommended to clients because technically it broke out, it looked really good, but it's not a vehicle that I want to use for a trend, just FYI. And there are others, but basically you get the idea that this 10-week, once we can kind of break some prior highs and stay above the 10-week, whether you're just entering a new position or you are, very much trend trading a major theme like tech, industrial metals and mining, which just has not done anything wrong. So that's kind of a list. I have many more. There are a few others. Vertex was a play back at 181. It was a fundamental thesis. Basically, it was a bottom fishing play. It also warned clients when it got extended that it needed to digest and come back to the 10-week and hold before it could go to the next level. So this is still in play. So this is basically what I do with clients. I have a fishing club subscription. I have the Big Ideas, which is just trend trading. So this is literally just the trend trades. And then I keep it updated. So JB Hunt, for example, recently and Old Dominion fell apart. Not good. I added this position just recently and it's not really doing gangbusters. Gold is okay. Weyerhaeuser is okay. Dividends, not going to win any races. So some of these are just slow to launch. I wanted to have a little exposure to silver and gold and miners, but the stuff that is obviously extremely working well, the oil, gas, coal, commodities that we got in early, agriculture, fertilizers, uranium, wood. I've been a big, lumber. I love trading, sizing up lumber and specifically RFP, BJs. You get the idea. But it's the point is, it's a lot of things, not paper. So kind of getting back to the end of this, the 10-week EMA, exponential moving average, I think it will really help you. Even if you just look at this from a standpoint of your swings or your chases, be on the right side of the trade. It really helps a lot. And then the oil trade that I've just had a question, not a question, but a comment regarding my my oil price target that did hit when I did this presentation back in October, and I said 130 crude oil. We did hit it. My next target is 160, and I think it's going to hit by June. So this is an SPX to CRB ratio. It's part of my intermarket analysis, and it's part of the reason I came up with this things over paper, because this little spike here represented paper over things, which meant that just oil was negative. NASDAQ was ridiculous from a valuation standpoint, and I believe we were going to reverse, and we have, and we've got more to go. So I believe that we could also head down to about this ratio could head down and oil could head up to about 260 by the end of the year. All right, so if any of this is of interest, chases, swings, or trends, you know where to find me, LaDucTrading.com. And I have several products from Discord, which is a great product for active traders who are maybe younger or newer and they want a community to work with. Fishing Club, which is live trading room, very, very full Slack presence, not just my own analysis, but like I said, I have a total of 8 contributors, from macro to oil to futures to advanced options to momentum trading. You get the idea, to gamma, single stock option gamma. So it's a very full community, fabulous. I love these. This team is just really, really strong. So I'm excited about that. I am very picky about what I recommend, obviously. I only want highest probability trading and investing setups. I'm not going to write every day about stuff that doesn't matter. I'm only going to pop up and say something or write something when I have something that's actionable and something that I think is very important. Like we're going to, get some volatility, or oil's moving higher, or look at these trend trades. Anyway, actionable insights, that's my job. And then of course, protecting profits when we get to some places. Like right now, I think we need to take really big care. Like I think these trends have been phenomenal, and they have not done anything wrong. But I think we're going to go into a volatility regime during this earnings season for the next few weeks. And I want folks to be on guard, which is why the next post that I actually just put up here, and I haven't actually sent it to clients yet, is I think it's time to take care. When you feel like I've not shown this publicly, this list, my clients have it, but I've not shown this publicly. That's, when you feel like bragging, it's probably time to sell. This is done so well. And I have, like, nobody knows I've had ATI since whatever, right? Like nobody can, Twitter doesn't know, clients only know. This is when I'm getting worried. Like we've had such a fabulous run that it's time to really take care and protect. I don't think the market is safe. I've said that. I definitely think NASDAQ will underperform, and I'll keep you posted, especially if you're a client. So I hope that helped a little bit. I definitely invite you also, James, my marketing director, puts together this kind of like event special. We haven't had one for several months. So there's some special there for joining. I don't even know what it is, but it's for you to try out. And then if you have further questions, you want to get a hold of me, I am on Twitter. I've got a macro channel that I run, obviously, and Tiffany runs LaDuc Trading. So just keep that in mind. Got a LaDuc Trading YouTube channel. Rithika posts her videos every week, plus my presentations like this one, that'll be up there. So from Discord to Big Ideas, Fishing Club, I've got some algo risk indicators and institutional edge. Have a look. And I know I don't have any time for too much in the way of Q&A, but I definitely want to thank our hosts, Anka and David, for putting this series together. And I definitely want to encourage you to put the 10-week EMA, exponential moving average, on your chart.